Silver just crossed $100. And in the same moment, one of the largest precious metals dealers in North America stopped buying, not slowing down purchases, not adjusting premiums. Complete suspension. When price surges, dealers fight for inventory. That's how markets work. Unless they know something the public doesn't, unless they've seen the delivery schedules, unless they understand what happens next when the paper contracts can no longer be honored. The question isn't why silver hit $100. The question is, why are the professionals walking away from the table right now? What do they see coming? Welcome to Currency Archive, where we document the financial shifts that matter to those who've built something worth protecting. If you've spent decades watching markets, building businesses, making decisions that affect real capital, then you understand that information like this doesn't stay quiet for long. Do me a favor, hit that subscribe button, not for algorithms, but because you'll want to see what comes next in this story, and drop a comment below. Tell me where you're watching from. New York, London, Singapore, Dubai? Because what's happening with silver right now isn't happening evenly across the world. Some regions are already locked out of physical supply. Let's see if yours is one of them. Now, let's talk about what just happened and why it matters more than the headlines suggest. For nearly 9 months, the silver market had been doing something that skeptics said would never happen, something the critics called impossible. They had predicted silver would collapse back into the teens. They had laughed at the stackers. They had dismissed the believers. But on this particular day in January 2026, silver crossed $100 per ounce for the first time in recorded history. The SD Bullion spot price tracker displayed the number clearly 121 per ounce. It wasn't a glitch. It wasn't a temporary spike. It was real. And it represented something far more significant than just a psychological milestone. The speed of this movement was extraordinary. At the end of May, silver had been trading under $33 an ounce. Now, just months later, it had tripled. The mathematics were undeniable. The momentum was unprecedented. Looking at the 1-week chart told an even more dramatic story. The previous Friday, silver had closed at $90.15. That meant in just 5 trading days, silver had gained over 10%, a full $10 move in a single week. But the 24-hour movement was perhaps the most telling. Just one day earlier, around the same time, silver had been trading at $93.45. In 24 hours, it had surged nearly $7. This wasn't gradual appreciation. This was acceleration. The stacking community, those individuals who had been accumulating physical silver for years, sometimes decades, felt a profound sense of vindication. They had endured mockery. The cryptocurrency enthusiasts had called their silver boomer rocks. Financial advisors had told them they were wasting their money. Family members had questioned their judgment. But they had remained steadfast. They had believed that silver was fundamentally undervalued. They had studied the industrial demand. They had analyzed the mining ratios, silver coming out of the ground at only 8-to-1 compared to gold, even when gold was trading over $4,000 an ounce. They had understood that eventually the market would have to reconcile this imbalance. And now, finally, silver was making the move they had always believed it would make. But something else was happening simultaneously, something that revealed a deeper structural problem in the market. While the price was surging, the very infrastructure that supported silver trading was beginning to crack under pressure. Coin shops across the country were experiencing unprecedented stress. The excitement in the market had created a paradox. While investors celebrated the price increase, dealers were facing a crisis. Many shops were buying far more silver than they were selling. The flow had reversed. Refiners had begun lowering their purchase prices. They were overwhelmed. Backlogs were building. And here was the critical point that most people missed. Outside of perhaps a few specialty items like 2026 American Silver Eagles, virtually no coin shop anywhere was actually paying $100 per ounce for physical silver. Think about that for a moment. The spot price showed $100, but if someone walked into a coin shop with a 10-ounce silver bar and asked for $1,000, they would almost certainly be told no. In fact, many shops had stopped buying silver entirely. This wasn't theoretical. This was happening in real time at some of the largest and most reputable dealers in the country. Scotsman Coin and Jewelry operated one of the largest precious metals operations in Missouri. It was widely considered the biggest dealer in St. Louis. They had a reputation for fairness. They had been in business for years. They were not a fly-by-night operation. And yesterday, they had posted an announcement that sent shockwaves through the community. At this time, we are temporarily unable to purchase silver and other precious metals. The announcement was direct. They had even stopped buying gold temporarily, though they had resumed gold purchases by the next day. But silver remained suspended. They were still buying gold and silver jewelry. They were still buying sterling silver flatware. But silver rounds, silver bars, 90% silver coins, American Silver Eagles, all suspended. The reason they gave was telling. This pause is due to our secondary market partners reaching their current limits. While we wait for those balances to be paid down, we are unable to responsibly process additional purchases. That word, responsibly, was crucial. Scotsman wasn't saying they couldn't buy silver at all. They were saying they couldn't buy silver and remain fair to their customers. They made this explicit in their statement. Rather than having to significantly reduce our purchase prices or changing our standards, we've chosen to pause purchases until we can resume business at the level of service and value you deserve and expect. This was the sign of an honest dealer. They would rather stop buying completely than exploit their customers by offering unfairly low prices. They understood their reputation was worth more than short-term profit. But this decision also revealed something much larger. If one of the biggest dealers in Missouri couldn't absorb more silver, if their wholesaler partners had reached capacity, if the entire secondary market infrastructure was hitting limits, then what did that say about the true state of the physical silver market at $100 per ounce? The answer to that question would become clear in the days ahead. There was a conversation that happened earlier that week, an interview between content creators discussing the silver market. One of them was Josh from Bullion. And in that conversation, Josh had said something that most people weren't ready to hear. He had said that some of the smaller coin shops wouldn't survive this rally, not because silver was going down, not because demand had dried up, but because silver had gone up too fast and the entire dealer ecosystem wasn't built to handle what was happening. Most people watching silver hit $100 were celebrating. They were checking their portfolios. They were calculating their gains. They were vindicated after years of being called fools for stacking physical metal. But behind the scenes, in the back offices of coin shops across America, a different reality was unfolding. The problem wasn't just about how much dealers were paying compared to spot price. That was visible. That was something customers could see and complain about. The real problem was something most customers never considered, something that was quietly strangling dealer operations. Cash flow. Like when a dealer buys silver from a customer, they don't just hold it in their shop forever. They send it to wholesalers. They send it to refiners. These secondary market partners process the metal, verify it, and eventually pay the dealer. That's how the system works. That's how it's always worked. But here's what had changed. The backlogs had become massive. Wholesalers and refiners were now taking weeks, not days, weeks to process incoming silver shipments. The volume flooding into their facilities was unlike anything they'd seen before. Every dealer in the country was shipping silver. Every refiner was overwhelmed. And until a shipment was processed and confirmed, the dealer didn't get paid. Josh had explained this clearly. When dealers ship silver to wholesalers, they lock in the price immediately. So if a dealer sends 2,000 ounces of silver when spot is at $95, they're guaranteed that price. Even if spot drops to $75, then before the wholesaler processes it, the dealer still gets paid based on $95. That protection exists. That's standard practice. But the payment itself, that doesn't come until the order is verified. And if verification takes 3 weeks because of backlogs, the dealer waits 3 weeks for their money. 2,000 ounces of silver at current prices represents over $200,000. That's not small money. That's operating capital. That's the cash a dealer needs to keep their doors open, to pay rent, to pay employees, to buy more inventory from customers who walk in wanting to sell. And if that $200,000 is locked up for 3 weeks, and another batch is locked up the week after, and another the week after that, the dealer runs out of money. Not because they're losing money, not because they made bad decisions, but because their capital is frozen in transit, sitting in warehouses waiting to be processed. Most coin shops don't have unlimited reserves. The small to medium-sized operations, the ones that make up the majority of the industry, operate on relatively thin margins. They need cash flow, they need turnover, they need to be able to buy and sell continuously. But when the buying dramatically outpaces the selling, when customers are bringing in 5 times more silver than they're taking out, when every dealer in the region is experiencing the same imbalance, the system breaks down. This is what Scotsman Coin and Jewelry meant when they said their secondary market partners had reached their current limits. It wasn't just that the partners didn't want more silver. It's that the partners physically couldn't process what they already had fast enough to keep money flowing back to dealers. Scotsman had chosen to stop buying rather than create an unsustainable situation. Rather than commit to purchases they couldn't responsibly fulfill. Rather than promise customers fair prices and then discover weeks later they couldn't honor those commitments because their own money was still tied up in processing. And Scotsman wasn't alone. They were just honest enough to post it publicly. Across the country, other dealers were making similar decisions. Some were cutting their buy prices drastically, offering 60 or 70 cents on the dollar just to slow down the incoming volume. Others were limiting purchases, only buying small amounts per customer. Others were stopping entirely. The speed of silver's rise had created this problem. If silver had taken 4 years to go from $33 to $100, if the climb had been gradual and steady, the market would have had time to adjust. Refiners would have scaled up capacity. Wholesalers would have hired more staff. Dealers would have developed strategies to manage the flow. But it hadn't taken 4 years. It had taken months. And the infrastructure simply couldn't keep pace. So, while the world celebrated $100 silver, while social media exploded with excitement, while stackers felt vindicated, the dealers who actually moved physical metal were quietly drowning in inventory they couldn't process fast enough to stay liquid. This was the hidden crisis, the one happening behind the counter, the one most customers would never see, until the day they walked into their local shop and found a sign on the door. Temporarily closed, unable to purchase, there was a strange phenomenon occurring in the silver market that most casual observers were completely missing, and it revealed something fundamental about how broken the pricing mechanism had become. The spot price said $100. The charts showed $100. The financial websites displayed $100. Every ticker, every app, every price feed in the world agreed silver was at $100 per ounce. But try to actually exchange physical metal for that price, and suddenly the number meant nothing. This wasn't a small discrepancy. This wasn't dealers taking their usual premium or charging a modest spread. This was a complete breakdown of the relationship between the quoted price and the actual transaction price. Walk into nearly any coin shop in America with a standard 10-ounce silver bar. Ask for $1,000 based on the spot price of $100 per ounce. Watch what happens. The answer would be no, not we'll give you $95, not how about $950. Just no, we're not buying. We can't buy. We've stopped purchasing. And for the shops that were still buying, they certainly weren't paying anywhere close to spot. Some were offering $70 per ounce. Some were offering $65. Some were offering even less. So whose price was real? The digital number on the screen? Or the actual cash that exchanged hands when metal changed ownership? This is where the conversation needed to go deeper, because this disconnect didn't appear overnight. It had been building for months, and it revealed a truth that the silver community had been discussing for years, but that mainstream finance had always dismissed. The paper market and the physical market were separating. For decades, the price of silver had been determined primarily by futures contracts traded on the COMEX exchange in New York. Traders bought and sold contracts representing silver, contracts that could theoretically be settled with physical delivery, but in practice, almost never were. Most contracts were settled in cash. Traders took profits or losses in dollars. The actual metal rarely moved. The system worked because everyone agreed to play by the same rules. The paper price was treated as the real price because enough people believed it was. But belief is a fragile thing, and when physical metal becomes scarce, when delivery becomes difficult, when dealers can't get their hands on actual bars and coins fast enough to meet demand, belief starts to crack. What was happening now wasn't just dealers being cautious. It wasn't just refiners being slow. It was a fundamental question emerging in the market. If you hold a paper contract that says you own silver at $100 per ounce, but you can't actually get physical silver for $100 per ounce, then what do you really own? The industrial users were starting to ask this question. The manufacturers who needed silver for solar panels, for electronics, for medical equipment, they couldn't afford to wait weeks for delivery. They couldn't afford to discover that their contracts might settle in cash instead of metal. They needed the actual material, and they were willing to pay above spot to guarantee they got it. This created a two-tier market. There was the price for people trading paper contracts who never intended to take delivery. And there was the price for people who actually needed the physical metal in their hands. And those two prices were diverging. Some refiners had started quoting different prices for immediate delivery versus delayed delivery. Some wholesalers were offering premiums to customers willing to wait longer. Some dealers were creating waiting lists, telling customers they could get silver, but it would take 6 weeks, maybe 8 weeks, maybe longer. This had happened before in history. Not with silver specifically, but with other commodities during shortage conditions. When the physical supply couldn't meet the demand implied by paper trading, the system had to resolve the imbalance somehow. Usually, it resolved through price. Physical would trade at a premium to paper until either more physical supply entered the market or paper demand decreased. But there was another way it could resolve, and this was what worried the people who understood market structure. It could resolve through settlement failure, through contract defaults, through the paper market simply admitting it couldn't deliver what it had promised. No one knew if that would happen with silver. No one could predict with certainty how this would play out, but the signs were there. Dealers stopping purchases, refiners with week-long backlogs, wholesalers hitting capacity limits, physical premiums rising even as spot price rose. These were not the characteristics of a healthy, functioning market. These were the characteristics of a market under severe stress. A market where the infrastructure that connected buyers to sellers, that connected paper to metal, that connected price discovery to actual transactions, was beginning to fail. And the most unsettling part? Most people buying and selling silver had no idea this was happening. They saw the spot price, they assumed that was reality, they made decisions based on numbers on screens. But reality was happening in the back rooms of coin shops, in the warehouses of refiners, in the strained conversations between dealers and their partners. Reality was the growing gap between what silver was supposed to cost and what it actually cost to get your hands on it, and that gap was widening every day. There's a principle in markets that most people forget during moments of excitement. When everyone is celebrating, that's usually when the real story is being written somewhere else, somewhere quieter, somewhere the crowds aren't looking. Right now, the crowds were celebrating $100 silver. Social media was filled with victory posts, stacking communities were sharing screenshots. People who had held silver for years were finally feeling validated. But the professionals, the people who actually moved metal for a living, weren't celebrating. They were stepping back. They were pausing operations. They were quietly exiting the market at the exact moment when conventional wisdom said they should be diving in deeper. And that behavior should tell you something. When a major dealer stops buying silver during a price rally, it's not because they're afraid of losing money on the metal itself. Remember, when they ship to wholesalers, they lock in the price. They're protected from downside risk on inventory they've already purchased. So why stop buying? Why turn away customers who want to sell? Why post public announcements saying they've temporarily suspended purchases? Because they see what's coming next. And what's coming next isn't something they want to be caught in the middle of. Think about the position these dealers are in. They've been buying heavily for months. They've accumulated enormous amounts of silver. They've shipped it all to their wholesale partners. And now they're waiting for those partners to process everything, waiting for their money to come back so they can operate normally again. But while they wait, the market keeps moving. Customers keep coming in. The price keeps climbing. The pressure keeps building. Scotsman Coin and Jewelry had put it perfectly in their statement. They said they wanted to operate at the level of service and value you deserve and expect. That phrase wasn't just corporate language. That was them saying something very specific. We can't promise you fair treatment right now because we don't know what fair treatment looks like anymore. We don't know when we'll get paid for the silver we've already bought. We don't know what our wholesalers will do if the backlog keeps growing. We don't know if the system can handle what's happening. And rather than make promises we might not be able to keep, we're just going to stop. That's not panic. That's not incompetence. That's actually extremely smart risk management. Because here's what the professionals understand that casual observers miss. Markets don't move straight up forever. And when a market has moved as far and as fast as silver just did, from $33 to $100 in a matter of months, something has to give. Either the price corrects, or the infrastructure breaks, or both. If the price corrects sharply, dealers holding large inventories get hurt. Even with locked-in prices on shipped metal, they still have risk on anything sitting in their shops. They still have exposure to customer sentiment changing. They still have to manage the psychology of a falling market while sitting on six-figure inventories. If the infrastructure breaks, if wholesalers can't process orders, if refiners start refusing shipments, if settlement times stretch from weeks to months, then dealers are stuck. Their capital is frozen. They can't operate. They can't serve customers. They might not even be able to keep their doors open. So the smart move, the professional move, is to step back before either of those things happens. Stop accumulating inventory. Stop making commitments. Preserve capital. Wait for clarity. And that's exactly what was happening across the industry. Not everywhere. Not all at once. But in enough places that the pattern was undeniable. The largest dealer in Missouri stops buying. Other dealers quietly reduce their purchase prices to levels that discourage sellers. Refiners extend their processing times. Wholesalers communicate that they're at capacity. These aren't isolated incidents. This is coordinated risk reduction. This is the market's immune system recognizing a threat and responding. Now here's the question that should keep people up at night. If the professionals who do this for a living are stepping back, if the people with the most information, the most experience, the most market insight are choosing this moment to pause, what do they know that the celebrating crowds don't? Maybe they're wrong. Maybe they're being too cautious. Maybe silver goes to $150 and they miss the opportunity of a lifetime. Or maybe they understand that $100 silver happened too fast, that the infrastructure wasn't ready, that the gap between paper price and physical reality has grown too wide, that something has to reset. And when markets reset after moves this extreme, it's rarely gentle, it's rarely orderly, it's rarely kind to the people who were last to understand what was really happening. The professionals weren't selling out of fear. They weren't abandoning silver as an asset. They were simply reading the signs that most people weren't trained to see. The backlogs, the payment delays, The wholesale capacity limits, the physical delivery problems, the premium divergence, the infrastructure stress, all of it pointed to the same conclusion. $100 silver wasn't the destination. It was a waypoint, a marker on a journey that was about to get much more complicated, and the professionals wanted to be positioned correctly before the next phase began. They weren't asking whether silver would go higher. They were asking a different question entirely. When the system can't handle the price it's already at, what happens when it tries to go even higher? The answer to that question would determine who survived what came next, and who didn't.